This is part 2 of our video lecture for chapter 14, where we continue looking at C-type corporation taxation. And what we see here is the basic tax formula for a corporation that we had covered in part 1. But we start off again with our gross income, all the company's income. Then we subtract out most of the company's deductions except charitable contributions, dividend received deductions, and short-term capital losses that are carried back from future years that are calculated down here. So we have our taxable income here, and then we're going to take 10% of this tentative number, tentative taxable income. And that's the limit of how much we can deduct as a charitable contribution. And if you have any excess charitable contribution you cannot deduct here in this current year, then you can carry it forward for 5 more years before they expire. So we end up now with the next taxable income to determine how much we can deduct as a dividend received deduction. Keeping in mind here in the gross income are all the dividend incomes our corporation has received. But now we can possibly subtract out a deduction based upon the percentage ownership we have in the paying corporation. And that amount could be as low as half of the dividend if you own less than 20% of that paying corporation. Or if you own 20% under 80%, you can get a 65% dividend received deduction. And if you own 80% or more, all of that dividend you receive now can be deducted as a dividend received deduction. Okay, so now we get to the next taxable income to determine how much of any short-term capital losses that you have incurred in, again, future years, you can carry back to the current year. And again, keeping in mind here in the gross income, you have all the current capital gains being taxed, minusing out any current capital losses. And if you end up with a net capital gain, that means now any future capital losses you can carry back to offset this current year's net capital gain. If you have a capital loss in the current year, we know that you cannot deduct it to offset any other income for that year. So you have to either carry it back to a previous year or carry it forward if you don't use it to a future year. Then we get to our true taxable income for the year that we multiply by 21% to get the tax for the whole year. Now, what would happen if we end up with a negative taxable income for the year? We call that situation a net operating loss. And the rule in our textbook before the coronavirus situation is that we can only carry forward this loss to future years to offset future years' taxable income up to 80% of those future years' income, taxable income. Yeah, that's a good benefit. But the government wants to help corporations in this stressful time, economic time, by allowing them now to carry back the loss up to, let's say, I think it's 5 years. And there's no 80% limitation now, at least for the next few years of NOLs being incurred. You can forgo this carry back of 5 years and still keep carrying forward to future years. But I'm pretty sure most corporations with NOLs want to carry it back to past years, not because they need the cash right away, but because in past years, the tax rate was higher than 21%, whereas future years, the rate is still going to be 21%. So your deduction, the NOL deduction, is going to be worth more if you carry it back versus carrying it forward. And the form that you probably would use to report any carrybacks deductions is this one called an 1139. And you can see here there's 3 sets of columns, basically really to just carry back losses for the last 3 years. But now again, we know that we can carry back NOLs. That's NOLs for now the past 5 years. And for most corporations coming out of the past recessions, they were very profitable. So there's probably taxable incomes they can offset and get back a refund. Here you can see the capital loss that you can carry back. Remember, that's still limited to 3 carryback years. Okay, that's Form 1139. And if you cannot use this form, and you can see the revision date was before the coronavirus event, you may be able to use this 1120X amended form, but you have to do one form for each separate year. And probably here on page 2, you would check off the box saying that you're carrying back either a net operating loss. Again, you can go back now for 5 years, or carrying back a capital loss to the extent of any net capital gain you have in those previous years up to the past, I believe, 3, not 5, but 3 previous years. This is Form 1120X. Let's move on to the calculation of the tax, which is going to be done on Form 1120. And there's a third video linked in our chapter resources folder for chapter 14, showing you this 1120 form. Really, the video was made for another class. The tax return for a corporation is due 3.5 months after the year is over. So just like individuals. So if you were a calendar year end corporation, just like individuals, your tax return will be due on April 15th. There's a special due date for corporations with the year end of June 30th, as you can see here. And again, with the COVID relief tax situation, this April 15th date is now automatically extended to July 15th. Also, any balance due and taxes due on April 15th is also extended to June 15th. Now, if you want to extend your return beyond that date, you need to file an extension form called a Form 7004. This allows you another 6 months to file your return. It does not extend the time to pay the tax. If you pay your tax late, there may be a penalty. This just allows you to extend the filing of the 1120 form. And again, there's a special rule for taxpayers that have a year end of June 30th. So again, the flat rate for your taxable income is 21%. So here's an example where we have a taxable income. Remember, that's the bottom line of that basic tax formula. And all we do is multiply that by 21%. In previous years, there was a graduated rate, probably going up to 35%. And then this whole tax here has to really be paid during the year, not really after the year's over when you file your return. So just like individuals, corporations are required to pay estimated tax payments during the year. And you can see there's going to be 4 payments where you try to pay at least 25% for each of the payments. The first payment is due the same date as the tax return from the previous year. So sometimes this is a big hit if you have to pay a balance due for the last year's taxes. Now you got to pay 1/4 of the current year's taxes. And then just 2 months later, you have to pay the next quarterly payment. And then here's 3 months. And then the last payment is not after the year's over like individuals where they can pay on January 15, but here for a corporation, it's the last month of the year. Now, it's very hard to estimate during the year how much taxable income you're going to have for that same year. So the government allows a couple different ways of determining how much to pay. One is to take a look at last year's total tax liability, and you can pay that total liability this year in those quarterly payments. Or if you can, try to estimate your current year's liability, and then you divide that by 4 to make those quarterly payments. This applies to small corporations. Small corporations meaning their taxable income for the year is going to be under $1 million. But if you're a large corporation, more than at least $1 million of taxable income, that's averaging for the past 3 years, you have to use the current estimated year's tax liability and pay again 1/4 for each of those quarterly payments. Let's talk about now the corporation paying out dividends or distributions to their shareholders. So let me illustrate this on a separate paper here. Let's even go back a step. So let's start off with a shareholder that's going to form a corporation. And the corporation needs funds. A corporation needs assets to run. So the shareholder is going to make a contribution, probably cash, or probably maybe even an existing business being contributed into the corporation. And the general rule that we read at the beginning of chapter 14 is that this would be a tax-free exchange. The shareholder is contributing assets into the corporation, most times cash, could be other types of assets, and the shareholder is taking back stock of that corporation as a shareholder. And generally, this is a tax-free exchange. Sometimes we call this a Section 351 transaction or a 351 exchange, tax-free exchange. But if the taxpayer takes more than stock back, like cash, that could turn this exchange to be taxable to the shareholder. Or if the corporation assumes liability in excess of the basis of the assets, there could be some tax liability owed by the shareholder. Okay, so that was covered at the beginning of chapter 14. Here at the end of chapter 14, what we're talking about is more stuff going to the shareholders, and we call this distributions. And the most common type of distribution is cash, a dividend. So let's talk about what you had learned in a previous accounting class. If you remember, a company's assets, everything it owns, should equal the liability the company owes plus the leftover equity. In fact, when you make this contribution into the corporation, that really is the asset here balancing off with a capital contribution or the equity. And each year, of course, we're going to report revenue minusing the expenses to get hopefully the company's profits. And that profit will be closed out into the equity section if you remember the retained earnings account. And now when you make a distribution during the year, you have to have enough assets, typically cash, to distribute to your shareholder. And you have to have enough profits accumulated or that retained earnings. You got to have both, yeah, to be able to legally pay out a dividend to a shareholder. So here in chapter 14, we use a little bit different terminology than the accounting, the financial accounting. What we call retained earnings is really earnings and profits. And the calculation is very similar. Not too many differences between these two. And to the extent you have earnings and profits, when a company makes a distribution to the shareholder, that's going to be taxed to the shareholder as a dividend. So this profit that the company earns is going to be taxed to the corporation, and any excess profits we have that's distributed going to be taxed again. That's what we call double taxation. So sometimes we avoid that by using not a corporation, but a partnership that we'll learn in chapter 15, or possibly a limited liability company that's going to be taxed as a partnership or sole proprietorship. Okay, so because of that double taxation, the shareholder may have to pay a tax, but maybe at a lower rate. Could be as low as 0%, or possibly for most taxpayers, a moderate 15% rate. And high income taxpayers would pay a 20% rate on their dividend distributions. Now, just because you make a dividend distribution doesn't necessarily mean it's going to be taxed as a dividend. You get taxed as a dividend only to the extent you have earnings and profits. And the corporation should determine whether that distribution is coming out of earnings or profits, or if not, any excess is going to be a recovery of the shareholders' capital, tax free. And if they get more than their basis in their stock, their capital, then any excess is going to be taxable as a capital gain. And again, capital gains long term, same rate as the dividend distributions, usually preferred rates. So the form that you would get if you were a shareholder is this 1099 DIV form from the corporation. And here would be the dividends coming out of the earnings and profits. Most times that same dividend here would be showing up here as a qualified dividend, again taxed at either the 0, 15, or 20% lower rates for our taxpayers. Now, anything in excess of the corporation's earnings and profits, the retained earnings, is going to be a tax-free recovery of the shareholders' basis in their stock, and that should show up over here in line 3. Now, the corporation may not necessarily know what the basis to the shareholder stock is. They're just going to show anything in excess of distributions over the amount of dividends over here. So it's up to the shareholder to determine how much of this is tax-free recovery of their basis in their stock. And anything in excess of that is going to be a gain, probably a long-term capital gain. Okay, all of this is again reported on this form 1099 DIV that is issued by the corporation, this pair over here, to the shareholder, the recipient over here. Let's take a look at an example of paying out a dividend that's in excess of this previous one here is for cash dividends, yeah. And then if you distribute out a dividend that's not cash, again, let's go back here. We're paying out a dividend here that's not cash. It could be maybe equipment of the company. It could be maybe a building and land of the company. Keeping in mind, this type of distribution we're talking about is not liquidating the corporation. That's a different situation. Okay, it's just maybe we don't have cash, but we have earnings and profits. So we're going to take some other asset the corporation owns and distribute that to the shareholder. So that's here in this next slide. We're going to distribute property that has increased in value compared to the basis to the corporation. And for tax purposes, that's going to be treated just like a sale by the corporation. And if there's a gain, the gain is going to be taxable. At the same time, that gain is like revenue increasing the company's retained earnings or earnings and profits. So that's going to be probably treating now that distribution as ordinary dividend income. So here's a situation we have Corporation ABC is going to distribute out not cash but land, and the land has a fair market value of $20,000, but the corporation's cost basis, adjusted basis, is only $4,000. And again, when you make this type of distribution of non-cash assets, it's going to be treated like a sale by the corporation. So we have a $16,000 gain that the corporation has to report and pay taxes on. Here we're told that the earnings and profits or retained earnings before this sale is 5,000, but it's going to be increased by that profit we have. So earnings and profits are going to be totaling up now to 21, and that's more than enough to cover the value of the distribution going to the shareholder. So all of that distribution of land at its value is going to be taxed as a dividend to the shareholder. Again, it's going to be taxed at 14,000, 16,000 to the corporation, and then it's going to be taxed again at 20,000 to the shareholder. Here's another example where we have a corporation alpha that has land worth 10,000, but the basis is 24. So we saw in the previous example, we had to pay taxes on the difference when the value was greater than the basis. But here, when the basis is greater than the value, there's uh, a loss, but it's not recognized for tax purposes. In other words, there's no deduction to the corporation. In fact, if you were this corporation, probably what you should do is sell the land to a third party and not distribute it to the shareholder. So now you can have a loss of 14,000, and either ordinary or capital loss you can deduct to certain limits, and then use the proceeds of 10,000 and pay out a cash dividend to the shareholder. Here it says that they have enough earnings and profits to make this $10,000 value taxable to the shareholder. Again, you don't want to do this, otherwise you would have a loss that the corporation cannot recognize. So you probably should sell this property to a third party and use the cash proceeds to pay out a cash dividend to the to our shareholder. Okay, that's it for this part 2 video for chapter 14. Make sure you take a look at that third video going over the corporate tax form, Form 1120.